Imagine being a part owner of the world's biggest companies without having to buy any stocks. Sounds exciting, right? Welcome to the world of mutual funds. Now you might be wondering, what in the world are mutual funds? Well, let's break it down. Picture a giant pot, where people from all walks of life toss in their money. This pot isn't for a community dinner though, instead it's used to buy a mix of stocks, bonds, or other assets. This pot, my friends, is a mutual fund, and as contributors you become part owners of all the assets in that pot. But here's the best part. You don't need to be a Wall Street whiz or have a stash of cash under your mattress to invest in mutual funds. Whether you're a school teacher, a college student, or a retired firefighter, you can toss your money into the pot. And no, you don't need to rob a bank to do it. A few dollars can be enough to get you started. So what's the big deal about mutual funds? Well, for starters, they offer diversification. That means instead of putting all your eggs in one basket, you're spreading them across multiple baskets. If one basket falls, don't worry, you've got plenty more. Then, there's professional management. You don't need to stay up late studying market trends or worry about when to buy or sell. That's the job of the fund manager. They're like the chef who ensures your pot of investments is cooking just right. And let's not forget about liquidity. Want to pull your money out? It's as easy as pie. You can generally sell your shares on any business day and get your cash back quickly. So are you ready to take a deep dive into the ocean of mutual funds? Strap in because it's going to be a thrilling ride. So you've decided to hop onto the mutual fund train, but where do you start? Right here with the ABC of mutual funds. Let's start with the term that sounds like a high-tech spaceship, NAV, or net asset value. This is the price at which you buy or sell units of a mutual fund. Think of it as the tag price of each slice of the mutual fund pie. Moving forward, we have SIP or Systematic Investment Plan. No, it's not a new kind of coffee order. It's a way to invest in mutual funds regularly, just like your monthly Netflix subscription. You decide the amount and the frequency, and voila, you're investing like a pro. Next on our list is lump sum. This term is as straightforward as it sounds. It's when you invest a large amount all at once in a mutual fund. It's like buying a year's worth of Netflix subscription in one go. Now let's get a bit more specific. We have equity funds, which primarily invest in stocks. Picture a teenager who loves living on the edge. That's an equity fund for you. High risk, high reward. On the other hand, we have debt funds. These are the play it safe types. They invest in government securities, corporate bonds, and other low-risk options. It's like the grandpa who prefers a quiet evening with a book over a rock concert. Lastly, we have hybrid funds. They are the best of both worlds, investing in both equity and debt. Think of them as the versatile friend who can party hard and yet ace an exam the next day. Phew, that was a lot of jargon, wasn't it? But don't worry, it'll all make sense soon. Just like ice cream, mutual funds come in different flavors. Let's dig in. Picture this. You're in an ice cream shop, and you're overwhelmed by the variety of flavors. That's exactly how many feel when navigating the world of mutual funds. But don't worry, we're here to help you understand these delicious options. First up, we have equity funds, the rocky road of mutual funds. They're packed with stocks and can offer mouth-watering returns, but remember, the ride can get bumpy. These are for those who can handle a bit of volatility for a potentially higher reward. Next, we have the vanilla of mutual funds, debt funds. They're made up of bonds and other debt instruments. They're more stable, but don't expect them to set your world on fire with high returns. They're great for conservative investors who prefer a smooth ride. Then there are hybrid funds, the Neapolitan ice cream of mutual funds. They're a blend of stocks and bonds, offering a balance of risk and return. Perfect for those who want a bit of everything. Sector funds are like your fancy gelato. They focus on specific sectors like technology or healthcare. They can offer high returns if the sector is doing well. But it's a risky treat because if the sector flops, your investment might take a hit. Next, we have index funds, the frozen yogurt of mutual funds. They simply mimic a market index. They're a low-cost option that gives you a taste of the whole market. Finally, we have fund of funds. They're like a sundae, a combination of different mutual funds. They provide diversification, but remember, too many toppings can lead to higher costs. Each of these fund flavors has its unique taste, risk, and return profile. Some are sweet and safe, others a bit more adventurous. It's all about knowing your palate, understanding your risk appetite, and choosing the flavor that's right for you. Remember, there's no one-size-fits-all in mutual funds. It's all about finding the flavor that suits your taste. Ever wondered who's behind the scenes making all the investment decisions? Meet the superheroes of mutual funds, the fund managers. Picture this. You're a superhero, armed with a unique power. Your power isn't super strength or the ability to fly. Instead, you have the power to make financial decisions that can influence the lives of thousands, maybe even millions of people. That's a fund manager for you. In the world of mutual funds, fund managers are the superheroes. They are the ones who decide where and how to invest the pooled money. They are armed with a sea of information, sophisticated analytical tools, and a team of analysts. Their mission? To make the best possible investment decisions on behalf of their investors. Fund managers are like the captain of a ship, steering it through the unpredictable ocean of financial markets. They use their expert knowledge and experience to navigate through economic trends, market conditions, and corporate performance. They analyze and interpret complex financial data to identify the best investment opportunities. But remember, every superhero has their unique style. Some fund managers might be risk takers, ready to dive headfirst into high-risk, high-return investments. Others might be more conservative, preferring to invest in stable, low-risk securities. The key is that they tailor their investment strategy to align with the objectives of the mutual fund they manage. Fund managers do not make these decisions on a whim. They conduct thorough research, engage in meticulous analysis, and follow disciplined investment processes. They scrutinize the performance of different companies, industries, and economies before deciding where to invest. And just like superheroes, fund managers are accountable. They are responsible for the performance of the mutual fund. If the fund does well, they share in the glory. But if it underperforms, they must answer to the investors. So while you're busy living your life, these superheroes are busy making your money work for you. Mutual funds are like a roller coaster ride, thrilling but not without risks. Let's buckle up and explore the risks involved in mutual funds. Just like the thrill of a roller coaster comes with the risk of losing your lunch, the potential returns of mutual funds come with their own set of risks. But fear not, dear listeners, for every risk is a puzzle waiting to be solved. First up is market risk. This is the big bad wolf of mutual fund risks. Market risk is the possibility that the entire market will go down, taking your mutual fund investments with it. It's like when the roller coaster takes a steep dive and you feel your stomach lurch. We've all been there, haven't we? Next on the roller coaster ride of mutual fund risks is credit risk. This is the risk that the company or government entity in which your mutual fund has invested will not be able to pay back its debt. It's like that moment of suspense when you're at the top of the roller coaster, teetering on the edge, and you're not quite sure if you're going to make it over the hump. And last but certainly not least, we have liquidity risk. This is the risk that you won't be able to sell your mutual fund shares when you want to. It's like being stuck at the top of the roller coaster, waiting for the ride to start moving again. But here's the good news. While these risks may seem scary, they're not insurmountable. Just as a roller coaster ride is made safer with a sturdy harness and a well-maintained track, mutual fund risks can be managed. You see, our superheroes, the fund managers, are here to manage these risks. They're the ones who research, analyze, and monitor the market and the investments within the mutual fund to ensure that the ride is as smooth and profitable as possible. Remember, with great returns come great risks. But don't worry, our superheroes, the fund managers, are here to manage these risks. With thousands of mutual funds out there, choosing the right one can be like finding a needle in a haystack. But don't worry, we've got you covered. First things first, identify your investment objective. Are you saving for a cozy retirement, your kid's college fund, or a trip to the moon? Well, maybe not the moon, but you get the point. Different funds serve different purposes, so it's important to know what you're aiming for. Next, let's talk about risk tolerance. If the thought of losing a penny makes you sweat, you might want to stick with lower risk funds. On the other hand, if you're more of a live on the edge type, high risk, high reward funds could be your game. It's all about how well you sleep at night knowing your money is at work. Now, on to fund performance. But remember, past performance is like old high school photos. It's not always a good indicator of the future. Instead, look for consistently good performers over a long period, not just the one-hit wonders. Consider the fees. Yes, even mutual funds have them. Lower expense ratios mean more of your money stays invested. It's like going to a buffet. You want to get the most food for your buck, right? Also, don't forget the fund manager. Think of them as the captain of your investment ship. A good captain can weather any storm and still keep the ship on course. Look for managers with a solid track record and a clear investment strategy. Finally, diversification is key. Don't put all your eggs in one basket. choose a fund that spreads its investments across a range of assets. It's like having a balanced diet, but for your portfolio. Remember, the right mutual fund is the one that aligns with your financial goals and risk appetite. So, take your time, do your homework, and pick wisely. After all, it's your hard-earned money we're talking about. Now that you've chosen your mutual fund, what next? Let's embark on the mutual fund journey, from investment to redemption. First things first, you've got to invest. Investing in a mutual fund is like buying a ticket for a long journey. The ticket here is a unit of the mutual fund, and the price you pay for this ticket is the net asset value, or NAV. Once you've bought your ticket, you're officially on the Mutual Fund Express. Now, you're not just a passive passenger on this journey, you've got to keep an eye on your investment. Tracking your investment is like checking the route map of your journey. You can do this by regularly reviewing the performance of your fund. It's like checking if your train is on the right track and moving towards your destination. But what if you want to get off the train before it reaches the final destination? Well, that's where redemption comes in. Redemption is like alighting from the train at a station of your choice. You can redeem your mutual fund units at any time based on the NAV of that particular day. The amount you get on redemption is the NAV per unit multiplied by the number of units you hold. Simple, isn't it? However, just like a train journey, there can be twists and turns. The value of your investment can go up or down depending on market conditions. But don't worry, if you've chosen your fund wisely and are patient, you're more likely to reach your financial destination. One last thing, many mutual funds offer the option of reinvesting the profits earned. It's like extending your journey with an upgraded ticket, aiming for a more exciting destination. And that's how you embark on a rewarding journey with mutual funds. So, are you ready to hop on the Mutual Fund Express? Remember, the journey is as important as the destination. Enjoy the ride. So that was a whirlwind tour of the world of mutual funds. Feeling enlightened, are we? Let's take a moment to revisit this exciting journey. We started off with a sneak peek into the world of mutual funds, understanding the ABCs, before tasting the different flavors they come in. We then met the superheroes of this world, the fund managers, who navigate the roller coaster ride of risks to bring us profits. Choosing the right mutual fund, we discovered, is like finding the perfect pair of shoes. It should fit your needs and comfort perfectly. And the journey doesn't end at investment, it continues till redemption, where you reap the benefits of your wise decisions. Mutual funds, as we've seen, offer a fantastic way to grow your wealth, providing a balance of risks and rewards. They are the Robin Hood of investments, making the market accessible to all. Don't forget to subscribe to our channel for more exciting and informative videos. Remember, knowledge is power, especially when it comes to your money. So keep learning, keep investing, and keep growing.